Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. And if you want to follow me, it's at @Finance. And if you'd like to join our community, finding-value.com, where I dive deeper into all these different sectors, looking for potential investment opportunities, sharing them with everybody in the community. I do that through midweek updates and Q&A sessions on the weekend. We do have a special going on. Special is the coupon code. Get you 50% off the first month only on the monthly membership. Ends up being $25 for the first month. And you get a larger discount on the yearly membership, $100 off if you like to sign up directly to the yearly or switch from the monthly to the yearly using special as the coupon code. All right, we've got Peter Lynch. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Yeah, I would agree with that. A lot of people have been calling for a recession ever since 2021. So 2020, we got the big print, we got the move going up in 2021. And then ever since like late 2021, people have been calling recession, recession, recession the entire time. Now, there have been a lot of companies, even in the oil space, where we've seen from 2022-ish a pullback in oil prices, and the oil companies are going up. I know, weird. It's not all of them, not all of them, but some of them are pretty resilient. They're pretty high. They're close to I'll say 52-week highs. I don't know about going all the way back to 2008. So that's a tough one because a lot of people call for corrections, they call for crashes, they call for recessions, they hit your fear button. They hit that scare tactic, get you the clicks on YouTube if you use scare tactics, and it comes to pass, and nothing really comes of this big, gigantic pullback in at least the sectors that I watch. Right now, most everything looks like it's bottoming and turning higher for the most part, in a variety of different sectors. So when I hear people talk about recessions, I hear people talk about a potential pullback, and all of that is definitely possible. I'm not saying it's not possible. I don't see it clear as day in the charts. So what I do is I look at the charts, I look at all the different sectors, I look at the patterns that are created, and it should match whatever narrative is being described. If we are going to get a recession and if we are going to get a pullback, wouldn't we see bearish formations in the charts, not necessarily bullish ones? That's where I'll leave it. I'll leave it at that. Here's Lucas. I like Lucas. I think he's done the research very close to what I've done. I did this like 10 years ago. Not stating that me doing it 10 years before him means anything. Doesn't mean I'm any more qualified than he is. But let's go through this. It says, what if shale didn't slow because of prices, but because of geology? And that's exactly where my mind is at. What if it's like the 1970s? U.S. conventional production peaked in the 1970s at 10 million barrels per day. Nixon launched Project Independence to boost domestic output. The rig count went up 35%. Capital expenditures are up 40 to 50% in 2 years. Oil sector share of national investment nearly doubled by 1978. The result, Geology won. By 2000, production had fallen 40% to 6 million barrels per day. No amount of money could offset geological decline. Let me repeat that again. No amount of technology or money could offset the geological decline in conventional oil in America. Then came U.S. shale, flipping the script, but with a catch. Decline rates of up to 90% in the first 3 years means that the higher shale output climbs, the faster it declines, and the more constant drilling is required just to stay flat. Shale is like running an ever-steepening treadmill. Eventually, physics wins. What if shale growth isn't slowing because of low prices, but because of geological constraints, just like in the 1970s? When shale rolls over, everything changes. I agree with that. So this is U.S. oil production by source. The lower 48, you can see in the red, we peaked in 1970, that little peak there, and we've never gone up ever since that. I mean, we've had some years that went up like right here. Maybe it was a small find or whatever, but we've been pretty much down. Now, what they did is they added stuff. They added Alaska, they added offshore, and then they added most recently tight oil that went up. This is from 2010. And we're past this up here with tight oil. Tight oil has gone crazy. But what I'm saying is look at the lower 48. It's never reversed. No matter what technology, no matter what drill rigs you throw at it, doesn't matter the quantity or the technology in the drill rigs, we've never been able to reverse that move. Now, could we have slowed it? Maybe, but I don't think we're ever going back above 7 million barrels a day for conventional oil. So if that is true, now this is where people get lost. They'll say, "Oh, technology will figure it out." If it's true, technology will not reverse the geological constraints, because what we've observed in life in fields, Pemex, U.S. oil production, Gawar, all the big boys, we've never been able to reverse the decline. Now, if oil is in some sort of deposit, and however much is in there, you're never going to extract more oil than what's in the deposit itself. It's not like we're manufacturing. Now, could we get more efficient? We could. We could easily get more efficient at getting more of it out per each well. So if we're only getting 10, 15, 20% out of the well, we can get more than that. So yes, there is things that can occur, but I don't think we'll get more than what's in the well itself, so to speak. And this one here is the U.S. crude oil and natural gas rotary rigs in operation. You can see the big move up in the 1970s. We had a huge boom in the energy service mix there because they spent all that money. We saw a big move up in energy service. I think that's coming again over here. When people panic, they're going to send the rigs out to drill. I don't know if it's going to work because it'll be geologically constrained. Exactly what Lucas is kind of alluding to here. And I think that's probably the case. As we're drilling out tier 1 wells versus tier 2, which is all coming, I think that's going to be the case. And we're seeing it on a lateral foot basis, the efficiency. We're seeing that we're drilling lower and lower quality areas. But what we're doing is we're making up for it by drilling longer and longer horizontals. So they're saying we're becoming more efficient per rig and per drill hole. But it's not efficiency measured in efficiency per foot. So what they're doing is they're drilling less quality geology and making up for it by drilling much longer. Stan Druckenmiller from 2022, he says, I will say this, it's conventional wisdom, which I agree with, that stocks go up over the long term. Okay, the problem is we've become a little complacent about what does long term mean. If you bought the Dow in 1929, you got back to even in 1954. As just pointed out, the Dow was in 1966 where it was in 1982. When you buy matters, this is called sequence of returns. He's talking about the cycle. The cycle where financial assets become overvalued, 29 and 66. And then they were undervalued in 54 and 82. But they were the same price in those years. That's the lost decades in there. So I think we're going to see another one of these. And I think that's what he's alluding to some degree. So Katusa says, the more we spend, the less we find. We can't get over this chart. That's copper's dirty secret right now. 3.2 billion dropped on exploration in 2024 and found exactly zero major deposits. Back in the 90s, about a $500 million got us 20 deposits. We're not finding anything, guys. They can drop all the money they want, and we may not find anything that's big. So when people say, oh, high prices cure high prices, well, they're dumping money and they're not finding crap. I mean, it's at some point, if it's a very large deposit, you'd think you could find it somewhat easily. If it's a very big boy, they're not finding it. They're dumping money, but they're not finding anything. Your biggest mistake is likely to be selling a big winner too early. Yeah, I can tell you that is a true statement there. When I was really young, I had some really big winners in the account. Now, I didn't sell out of them. I was forced out of them because they were held in my brokerage account in a 401k. The company I was working for got acquired by another company, and then I was forced liquidated in 2012. And there were a bunch of companies like Chipotle, Visa, MasterCard, United Health Group, like all those types of companies were in my 401k brokerage account. And I got forced liquidated and I couldn't open another brokerage account and buy individual stocks. They forced me into mutual funds. So I couldn't replicate the portfolio. I would have been better off quitting the company, finding a new job, and letting those companies ride. In fact, I would have been better off quitting that company, putting all of my money in a brokerage account, rolling it over into an IRA or something, and buying those same individual stocks that I held. I would have been far better off. Far, far, far better off. I would have made more money in my investments than I would have made working when looking back. Now, looking back is always 2020. It is always 2020 looking backwards. If I had known that, which I didn't because I think I was like 31 years old. I was 31 years old when we were taken over. Obviously, I was earlier in my career. I wasn't as good of an investor back then. I didn't know nearly as much. I was still studying and working and trying to gain skills at my job because that's where money was made, right? You make money at your job. I was still in that mindset for the most part. But if I had known looking backwards, you know what? These are some pretty damn good investments. I probably should keep them here. They would have paid way more doing that than the money I earned working. And that was a big lesson back then. Well, the lesson was learned later on, not when I was 31. It was 5, 10 years later. But I knew it was bad that they were going to liquidate me. I felt so bad. I should have quit. But look again, looking backwards is 2020 hindsight. Kurt says my client has $520,000 in unrealized capital gains. He's 74 years old. If he sells now, 15% of those capital gains tax is $78,000. If he holds until death, his heirs get step up in basis, which equals $0 in tax. The answer is hold it. Let them inherit it tax free. I didn't know that. Did you guys know that? So if you have a big gain on a previous person, and then if someone inherits it, you get a step up in basis. I did not know that. So hopefully you guys learned something from this. That I did not know. I did not know that. Another one from Lucas. He says you can't electrify the world without copper, and the world is running out of it. Large-scale copper discoveries are down 90% over the last 2 decades. Copper deficits are projected to widen through 2030. Copper demand is surging, driven by electrification, data centers, and AI. It takes 20 plus years from discovery to first production. This copper bull market will surprise everyone. both in magnitude and in duration, how long it lasts. I totally agree. The more I read from this guy, the more we are similar in our opinions. So we must have read the same data and have come to the same conclusions or something close to it. I look out in the future and I look at copper, I'm like, where are we going to get this? Like, it doesn't make sense. Now, even if we go and we try to mine all this copper dust, is what I'll call it, I mean, we're going to need a whole heck of a lot of energy. So, when I look out in the future and I just add this all up, and I continue to do this, and I'm still in disbelief because I don't know, I don't think the numbers add up that well. We have a massive demand for energy, electricity based energy, from data centers and from artificial intelligence. So combine those two together. We've got LNG terminals being built, and we've got all this natural gas demand, which effectively we're shipping natural gas all the way around the world, mainly, I think, to burn as electricity, but maybe for some heat too, for homes. And now we're sitting here and we're looking at shale, and we've got this big question mark around shale. Like, can we produce more out of these? I think we can for a little bit, maybe another 5 years or 4 years or something like that. After that, I'm like, what are we going to do? I mean, we are adding copious amounts of demand at like a not a linear scale, it's like exponential. And if we hit a constraint in natural gas where we can't produce as much as that we are adding on, what the heck does that even mean? And at the same time, in the background, we've got copper and all these other minerals, declining ore grades. They're not finding anything. And even if they were going to try to produce, that's all energy demand. We need to move more earth to get less material that we want. Everything is just going to dump on energy. Everything. Energy for technology, energy for mining, energy for this low ore grade stuff that we know exists. We've got low ore grades in silver, all this stuff. And I'm just kind of scratching my head over the next like 20 years and saying, yeah, I think energy is a pretty solid bet here. You go look at the ratios. I mean, oil is cheap as all get out. So is natural gas. It's still cheap, and coal is cheap. What a great setup! What a great time to be alive in. And the only way that they can kind of mitigate this is if they put us in this like recessionary move to slow down the energy demand. 'Cause, the rates are going to have to go up and try to slow this all down to balance the demand and supply. It's crazy. Here's one from the Seam. He says the entire investing industry is built on the illusion that you can eliminate risk by being smart. The truth is, you eliminate risk by being cheap. Smartness runs out exactly when the black swan arrives. Cheapness survives the black swan and gets richer from it. I've watched PhDs with 200 IQ models blow up while cigar butt pickers in Omaha compound at 20% for 60 years. The scoreboard does not lie, says Nassim. Yeah, margin of safety. Here's another one. Buffett is not a genius stock picker. He's a genius non-overpayer. He waits until the price is so low that even if the company does nothing for 10 years, he still makes money. Even everyone else falls in love with the company and pays any price. That's not investing. That is a love affair with the suicide pact. Another one from Taleb. And really, what it comes down to is just buying undervaluation. It keeps you at the bottom of the cycle. If you're at the bottom of the cycle, that's where you want to buy. You want to buy at the bottom. And at the bottom, things are cheap. At the top, things are expensive. It keeps you out of tops and keeps you in at bottoms. That is everything. And then they have the patience to wait for the setup, to buy the setup, and then to wait for it to go back up in a different market condition. That's investing. We've got Grady. He says this ratio chart shows that small, mid gold miners have broken out versus larger gold miners. This is what we want to see, as it means the more speculative, smaller stocks are starting to outperform the larger stocks. It means the market is buying more risk, which is bullish. That's what you see in bull markets, not in bear markets. The bear market, we've been in a bear market the entire time, guys. We just squeezed up here in 24, 25, and we've broken to the upside. This is the bull, baby. This is when you don't want to sell. You want to hold on to those shares and let it ride. Now, we're going to experience pullbacks. Things don't go straight up. That's the fact of life. It's the fact of the game. Things don't go straight up. They'll move up in waves and then consolidate during certain periods. And I talked about this one last time, so we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Specials, the coupon code. And that's all I've got for today. So we'll catch you next time, guys. See ya.